Wow. Holy cow, Josh.
You're welcome. You're
I
welcome.
felt like we were in the club. I'm sorry to anyone listening to that. My headphones, the bass in these headphones, out of control. What are we
Reply
doing?
in the comments if you liked our new opening music.
Wow.
If
There's
you
going to
liked
be
the club.
no comments at all.
There's going to be like 20 comments. They're going to say that was the best start to a live stream I've ever heard.
Wow. All right. Welcome back to another week of the Educated Homebuyer Live with Josh and myself to answer your mortgage real estate questions, update you on everything that's happening in the world of real estate and mortgage, and more importantly, mortgage rates, Josh, which have been hurting the housing market tremendously over the last couple of weeks. We saw some reprieve today. We saw interest rates actually get a little bit better, which we're going to talk about as we dive into the charts. But anything you want to add at the top of the show other than just admitting that you had everything to do with that music? And
that was all me. That was all me. They forget, those who have not been around for like 2 years, they forget the terrible stuff you used to subject us to at the beginning of every episode. So this was a bonus for them to get to, bob their head, club out a little bit before we start the show.
Club out. Oh, geez. What are we talking about here? Okay, guys, where are you watching from tonight? What's on your minds? Start putting it in the chat now. Let us know. That helps us get the show started. We always start with charts, which is what we're going to do tonight. But Josh, have you added them in? Did you add them back in? There they
get us in the right spot. Well, crap, I got us in the wrong spot now.
There we go. I got us. There we go. Right. We are looking good. So, guys, inventory, what is happening with inventory? We're up 24% over where we were last year. Nothing really to be concerned with there. We're still 19% under where we were in 2018, but inventory still continued to fall week over week. So we haven't seen inventory start to pick up nationwide quite yet, sitting at 624,000 homes, single family homes nationwide. And when we look, Josh, where is the There we go. Weekly change. We went from 635 down to 624. Again, our peak last year was sitting at 739,000 homes. Back in 2015, we were sitting somewhere in the high, 924,000 homes. So, again, we've got some ways to go before inventory gets back to those levels. But my guess is higher rates is likely going to allow inventory to pick up a little bit quicker than it normally would. And we're going to see that as we look here at Orange County and Huntington Beach, as we always do. You can kind of see that sharp just point up there on the chart. We haven't had one of those, quite frankly, looking back at when we started doing the data here, which was at the beginning of 2023, end of December of 2022, beginning of 2023. But Orange County sitting at 2,715 homes. That's up 5.82% week over week. And then Huntington Beach up 5.7%, sitting at 193. Josh, you look like you wanted to say something.
Just saying, were our Orange County and Huntington Beach residents just hibernating, just waiting, just sitting around with their DocuSign in hand, ready to go on January 1?
I think we had like 9 new properties come to the market today, which, again, if you're in Huntington, that's a positive thing. One thing we talked about in the podcast that's going to come out next week, which anybody that listens to the podcast, just a heads up, it's going to start coming out on Mondays instead of Tuesdays. So Mondays going forward will be the day that the podcast releases instead of Tuesday. So Monday, early in the morning. So just adjust if you need to adjust. If you're subscribed, and bell notification, you'll get that notification. You'll see it anyway, but just giving you guys a heads up. But anyway, we recorded today the housing market, kind of what's going on in the housing market, an overview. And one thing to keep in mind is, inventory is increasing, but a lot of it's at the higher price points, which really isn't impacting a lot of our listeners, unfortunately. This is a chart, Josh, that's really hard to read if you're on a small device. It's hard to cut it up in a way that you could read it, but it just shows months of supply. Miami, over 9 months of supply, whereas you look at Santa Clara, less than a month of supply. So depending on where you are in the country, again, real estate being local, you might be seeing a lot more homes come to the market. And then you might be going, Jeb, what are you talking about? Inventory is increasing like crazy here. And then you might be in another part going, Jeb, we haven't seen any increase at all. That chart is showing you exactly why you got the tell of that bifurcation, if you will.
I'm going to point out the obvious for everyone watching at home. Miami is in Florida, San Antonio, Texas, mid-Florida, Florida, Jacksonville, Florida, Louisiana, Gulf Coast, Austin, Texas, Alabama, Gulf Coast, Houston, Gulf Coast and Texas, Georgia, Gulf Coast, Atlanta. Atlanta is Georgia. So the biggest thing we are seeing is those Gulf Coast states. Not a lot of buyers. Louisiana is a very small state population wise for the U.S., but Florida and Louisiana are the ones having the toughest time of it in terms of just additional inventory. And if you're a seller, not so great. If you're a buyer, definitely more bargaining power.
All right. New listings, 45,000 new listings. Pretty big jump for the start of the year. 12% increase in sellers compared to the same time last year. Basically, the idea is that if the trend continues to follow pre-pandemic levels and rates remain elevated, inventory will start to rise to normal levels quicker, and the market will in turn shift more so than we've seen in the last couple of years. Total hung contracts pending sitting at 252,000 versus 250 last year and 231 back in 2023. Not a lot really to note there from the chart. And then percentage of price drops currently sitting at 33.9%, which is basically in between where we were 23, 24. So more or less pretty normal over the last couple of years. Nothing crazy there. So that gets us into jobless claims. Josh, we've talked about rates. We talked about inflation a lot, and the Fed is really starting to give employment more so the focus than anything else. Is essentially what we've been saying, and jobless claims being one of those measures that they're following. And Logan over at Housing Wire, his idea is that we need to see somewhere around 323,000 for a 4-week average on jobless claims for the Fed to really pivot in their stance. And so you can see from this chart, we're sitting at 200,000, Josh. I mean, some of the lowest levels that we've seen going back to,
I hear you, but ignore it. Ignore the last 2 weeks, because if you look back at last year, those were also the lowest 2 weeks of the year. No
Agree.
one during Christmas and New Year's is out filing for unemployment. So it's not that we can't say that's not the trend. It's that we need another 2 weeks before we're going to know what that actually tells us.
Good. But I like the chart. I like that they're putting it
chart.
out there now. So it'll be something that, assuming they continue to do it, you'll continue to see it. So
Let's skip this for a second. I want to, because this is the same data in a different chart. So it's not the same data. Those are the weekly claims, and the weekly claims, the chart from Housing Wire that Jeb just showed is probably the more important one. That's what we really need to see increasing. Not that you want to see people out of work, but if you want to see better interest rates, that's what you need to see increasing. So this last week, very volatile, a big jump up in interest rates, a drop in interest rates. And as you're going to see when we show you the charts, pretty much nothing, no movement. We're basically where we were a week ago. But I wanted to throw this in here, Jeb, because we hear last Friday that there was this blockbuster jobs reports. We have some really good analysts that are nerds that sit there for hours and dig it all apart. And they're like, well, it wasn't really as great as everyone says. But beauty's in the eye of the beholder. What I wanted to show with this chart, that's a pretty clear trend. We're having higher highs or lower highs and lower lows. So if you see, there's not a really perfect fit to this trend line on the way down, but based off of that jobs report from January or December, the January that was released here in January, we're out of the top of that trend line. So definitely something to keep an eye on, but we've seen such monstrous revisions with the NFP data. They're getting such, again, conspiracy theorist, this is your judge, your litmus test is whether you have a tinfoil hat on or not. Some say the government's cooking the books. The other says if you look at the survey, they're getting like 60% of the survey response on first questionnaire, first outreach, relative to what they got prior to the pandemic. So they're getting really bad data, and they improve the data as it goes, and you see big corrections as we go. So I think we will see that. We saw that last year. January had a big number and got revised way down. So likely to see that again. So what I wanted to show here, Jeb, what do we talk about in terms of interest rates? What's moving the market? Inflation and jobs lead into wages. So this here is 5-year TIPS inflation break-even rate. So it's basically a measure using inflation-protected treasuries to what the market expects inflation to be going forward. So 5-year forward. So if we look at that, the blue line there was about 1.79, I think is what it was on the left side in the middle of that gray bar. But you can see a lot of volatility, and that gray bar is one standard deviation above and below the average. Well, then we hit COVID and you see, oh my God, there's zero forward-looking inflation. And then post-COVID, holy geez, massive forward-looking inflation. And it's moderated, but now that line looks to be more like 2.5%. We will see what happens going forward. If for those who are saying higher for longer, this is the new normal, we're essentially at the average interest rates in terms of mortgages going back 200 years or whatever the crazy number is. That would be the belief. So I want to see what this chart looks like in 5 years, if this is a blip here or if this is indeed the new normal. We will find out.
If we're still here in 5 years, either something went really right or something went
Tell me what
really
your plan
wrong.
is. Tell me where you plan to be in 5 years if you do not plan to be here sharing your knowledge and information with these folks.
That's a good question, Josh. I don't have a 5-year plan for YouTube, unfortunately.
Okay.
Next week, we'll talk about my 5-year plan for YouTube. But honestly, if I'm here in 5 years, something either went spectacularly awesome or really wrong, and we're still here. If it was just middle grade, we're out of here. I mean,
all right. Well, we're not going to muddle through for 5 years. We're going to be sitting here and then we'll be internet famous. So this is what I like to show, little different look. We usually have a big zoomed out view of the 10-year treasury. This is just the purple box is the last 5 days. So last Thursday, not much movement from when we talked to you guys on Wednesday. Big move up in yields on Friday with that spectacularly hot jobs report, according to some. Monday wasn't much better. And then Tuesday, a little bit of improvement. And then the big move. So yesterday we had PPI. You're going to see those PPI numbers were better. That's a producer price index, not as direct an impact on interest rates, but then followed through with improved CPI today. We already looked at that fun little chart. This one here, I wanted to throw in because it also wages lead to inflation. So everyone's unhappy with inflation, but at the same time also doesn't want to acknowledge greater wage growth than prior to COVID. So you see those same crazy up and down spike and then drop during and post COVID. But if you look, we had average hourly earnings of employees. They were increasing about 10% or 10 cents per month prior to COVID. And now we're almost double that, like 20 cents per hour per month. So again, if this is the new normal, you're going to have more inflation and you're going to have greater wage growth. These things balance over time, but that's part of what the Fed is worrying about. They want everyone to have jobs. They want everyone to make good money, but not so much so that it causes them to run out and buy stuff and cause inflation. So PPI, as you can see, we had a really lovely number yesterday. The market kind of perked up and said, okay, but a very muted response because CPI was coming today and CPI is much more important. So this is back to 2020. Again, you can see the big spike and then this long drift lower. So great. We came in today at 3.2 versus 3.3% year over year expectations for core inflation, but we still have a gap there of 1.2% between where the Fed would like it to be. And we rarely hit 2%. You can see back here, we've been under it, we've been over it. So 2% is sort of a long run target. The forecast, this is the Cleveland Fed. They put out their forecast. They were dead on this month of where they expected it to be. If they are right next month, that 0.21 jumps in there. We will fall from headline CPI from 2.9 to 2.8% year over year. This number here for the core at 0.27, that would round up to a 0.3. We have a 0.4 falling off next year, so it would also drop another 0.1. But if it ticks down a little bit better and rounds to 0.2, we could see a nice improvement next month, and again, further the improvement that we've seen. This here is what people who are thinking that inflation is going to be looking better in a few months are looking at. So we got January, February, March, and April of last year, all well above 0.3 month over month reads. We just had a 0.2. So if we have 0.2s going forward, we're going to make nice progress over the next couple of months on that year over year number. Again, the Fed doesn't just look at that, because if we're at a 0.2 for the next call it the next 4 months, you're going to have inflation in the low twos. But when we're looking at it, even that, we would have a 4 or 5 month annualized rate at like 2.4%, still above 2. So making progress, but not on track to get back to 2. Jeff, I don't know if you saw this today. I kind of like this view of it a little bit better. Projection of no move here through the first couple months of the year. But earlier, after Friday, I think we were out to October is when they were expecting the first cut. Now it's 50-50 in May and about a 90% chance in June. Per the market, you guys know we go over that every week. Super volatile. We'll see where it is.
Go back to that, Josh, because now you have a second cut coming in December. So, which I don't think you had before. I think we were pretty static though once you did that first cut June or so. But again, this stuff's going to change like the wind as more data comes out. So it's so far out. There's very little to really pay attention to it.
We talked last week, Jeb. Our friend David Rosenberg, who we like to follow his data, has deconstructed all this and what he expects to happen with the owner equivalent rents and other measures of shelter inflation. With these 4 big numbers falling off, he thinks we're going to see lower than 0.2 numbers, at least a few of the months going forward. And he projects we're going to be 1.9 to 2.1 by the end of March. If that's the case, you're going to see 10-year yields considerably lower than they are right now. So we will watch and see. We've been burned enough here that we're gonna sit back and watch. We're gonna get your popcorn and we'll sit back and watch, Jeb. So again, if you look to the top right, that shows you those 5 days that we just looked at. We have a little bit of resistance at 463, another little bit at 4.58, and then a bigger Fibonacci level there. I want to say it's 4.56, somewhere around that. So long way of saying I wouldn't expect much more than maybe another 1/8% improvement over the next couple of weeks, because we don't really have any data. We've got a little bit of data tomorrow, Jeb. We get retail sales, with that including the holiday season in December. It's going to get a lot of play. You're going to see that in the headlines tomorrow. Friday we get jobless claims, which is always big, and then you get retail sales. So could be interesting. And then for next week, not a lot. We get Martin Luther King Day on Monday, so the markets are closed. No important data on Tuesday. Nothing really on Wednesday. jobless claims again the following Thursday, and then global services PMI. So really a dead zone here. We got jobs last Friday. We got CPI today. We've got about 10 to 14 days without a lot to move the market. So my guess would be we would slide down to one of those lines there, but it's less than 1/8% of improvement in the next couple of weeks. So what Jeb likes to say, if you are closing in a short time frame, and unless you are really risk and volatility tolerant, just lock your interest rate, because there's not a whole lot positive and hopeful in the near term before we get to PCE. Again, just wanted to show you guys the purple box there, 7.13 on the conventional, 6.5, 6.55, and 6.58 on FHA and VA per Mortgage News Daily. And they're basically flat or slight improvement over the week. So a lot of volatility, a lot of stuff happened between then and now, but didn't do a whole lot. It just circled us right back to where we were.
Yeah. So last week we talked about this. I think we have like 150 or so people registered at the moment for this webinar. It is January 28th. It's 5 p.m. Pacific Standard Time. It is online, right? You can sit in your soft pants on your couch and not even.
What if they want to watch naked? What if they want to watch naked?
No pants on at all and watch this from the from your couch, comfort of your couch, and just get all the knowledge you need to be able to buy right, borrow smart, and build wealth in 2025. We're calling it the Educated Homebuyer's Blueprint. It's a walkthrough of the home buying process. I said last week about an hour. We've done the outline now. We have it all done. It's probably going to take about an hour and 15 minutes to get through this thing, but it is there to guide you, to educate you, to give you what you need to know, to just kind of condense it all. Again, all of this information's out there. If you wanted to go scour my videos online, you could do it. This is going to take it all and condense it into one short period of time. So you can get there, Jeb Smith, JEBSMITH.net/seminar. Register there. You'll get confirmation. And from there, we'll guide you through that process. But again, January 28th, 2025 at 5 o'clock, baby. And for those of you who have rates looking to refinance, rates aren't moving down quite as quickly as we would like. But if you'd like us to watch them, jebsmith.net/rate watch, register there. And we'll definitely keep you in the loop of everything that is going on. So with that, Josh, that is the wrong one. Hey, do you guys, let's go back. We haven't done that one in a while. Do you like, I can't even get there. Do you like that? That's what we're going to call that 1. Or do you like 2? So just let us know.
They said they like the one with the cloudy bars over our faces is what they prefer.
1 or 2. Let us know in the comments. And we will we'll switch it to whatever you guys like. 1, you get a little bit more. So 2 is this. So we got a 2. So Josh, we stay static.
Status quo. I think we asked before, and they were pretty resoundingly 2.
But just, things change. And so we got to evolve with the times, Josh. All right. So we talked about the webinar. We've talked about what's going on in the market. Let's actually take it a step further and answer your question. So Josh,
since we just finished with interest rates, this is a comment, but I like it. Let's take this. M. Sandoval says, been waiting to locked on Monday. Today rates dropped 1/8%. What luck. You can look at it that way, but I would still say that it was the right call, because if we had got a hot CPI figure today, which last January, we got some surprising numbers. No one was expecting it. It came out of the blue, and you could have gone easily the other way. An 1/8 in the big picture. I don't know where you're located. I talked to some listeners to the show just before we came on here, looking at like a $275,000, $285,000 loan, and a 3/8 difference in their interest rate was $50 a month. So unless it's a really large loan, 1/8% is not a lot of money on a monthly basis. I realize every dollar is a real dollar, but so is your peace of mind. And generally, people are far more frustrated by not locking and rates going up 1/8 than locking and rates going down 1/8.
All right. With that, Josh, we're going to start with Maria. She has a question about adjustable rate mortgages, just asking to tell you more about the process. So what's the difference, Josh? Let's get really basic here between an adjustable rate and a fixed rate. And is the process any different in getting that loan?
The process is no different. There's no advantage in terms of qualifying. They're going to qualify you at a fully indexed rate. If it's 5 years or less, they can't qualify you at the start rate. If it's 7 years or longer, the rate's not going to be significantly better. So I guess if you did a 7-year ARM or a 10-year ARM and it was 1/8 or 1/4 better in interest rate, you would be able to qualify for a little bit more. But if it's 5 years or less, they have to do a fully indexed number there and qualify you at that. So the biggest issue, the reason why we have not seen a lot of these over the last few years, is we've had an inverted yield curve, meaning that short-term yields that adjustable rates are tied to have been higher than long-term yields. So most people, if they're giving up the security of a fixed rate, they want a nice 3/8% improvement down to an adjustable rate, and we haven't seen that. I know there are a few credit unions out there that loan their own money, and they've been a little bit more aggressive on this. Maybe you're at that 3/8 if you're willing to take a 5-year on. For the most part, just hasn't been an advantage. We've been in markets in the past with a normally steep yield curve where someone that's a first-time buyer and they know in 7, 8, 9 years that they're going to leave, that there's no problem. I'll take on a 7-year arm or possibly a 5-year arm if they're a little bit more risk tolerant. In general, what you're looking at is you could have rates go up as long as you're getting a 3/8 to a 0.5% improvement on interest rates. You could have them max cap out over the first couple years at the end of your fixed period and still have a lower cost of ownership while you're owning. So I'm a big fan of adjustable rate mortgages, hybrid adjustable rates where they're fixed for 5 to 7 years or 10 years and adjust. We just haven't seen the relative advantage to make it worth doing over the last few years.
All right. Taste of Luca. We'll go with that. I'm a first-time home buyer looking in Sacramento. Any benefit to buying a townhome over a condo? So the benefits of a townhome over a condo, for most people, I mean, again, to each his own with some of these things, but what I would say is typically a townhome only has people on either side. So, when I think of a townhome, I think of a 2-story building with somebody on your right, somebody on your left, you're all attached. That's more of a townhome. Condo, I think somebody maybe above you, somebody below you, somebody on either side of you. So you're kind of walled in.
Sounds like a good party.
Yeah, exactly. That's one benefit. Another benefit to townhomes or HOAs are typically less expensive because the HOA is not covering everything, right? So with a condo, a lot of times they're covering the roof, the exterior, water, sewer, trash, everything. So your HOA is going to typically be a little bit higher. Townhome, HOA is going to be lower, but some of those things aren't being covered. So you kind of have to decide to each his own. Townhomes, you typically get more of a patio or a yard in some cases, whereas a condo, you do not. These are all things you kind of got away. Sometimes with townhomes, you get an attached garage, attached carport in some cases, whereas condos are typically, different parking or structure parking, that sort of thing. So there's, it's hard to say because people look at them differently. It's, not all townhomes and all condos are categorized the same way. And lastly, townhomes are usually FHA approved, VA approved. They don't really need because a lot of them are on title. They're considered single family homes. They're just attached. So they look on title like a single family, but really they're townhomes. So most of them are VA and FHA approved, whereas condos have to be FHA, VA approved, and have to meet certain requirements. So it's a little bit different deal. So a lot going on there, but we've actually talked about it in videos.
Some more information and a wild card at you on this, Jeb. So in California, most parts of the country, townhouse is a style. So when you see it on the legal description, it's going to show as a condo. So it's a condo, but it's a townhouse style condo. Other parts of the country, there are legally defined townhouses. And on the mortgage side, anything less than 25% down on a conventional loan, you're going to have a condo hit. You're going to pay a higher interest rate. So unless you're home ready, home possible eligible, or under 100% of the area median where you are exempt from those loan level price adjustments, it looks like a townhome, sounds like a townhome, all the benefits of a townhome that Jeb just discussed, but it's treated like a condo, so the rate's going to be an 1/8 or 1/4% higher. If you're in other parts of the country, had a listener to the show, reached out. She was in Jacksonville. She says, townhouse. I look at it, I go, yes, very much townhouse style. I said, before I give her a number on this, let's go. And we looked it up, and sure enough, legally defined as a townhouse, which doesn't have those loan level price adjustments.
So good stuff. You get both sides of it there. Dixieland Production says, sorry, not a fan of the music, Josh. That's the only comment. Not a fan. So we've got
I'll go back.
one
I'm going
against
back
you.
to the well, Jeb. You complained and Dixieland complained. I'm going back to the well. I'm going to
I
go to
like
the
it.
YouTube audio library. I'm going to find something that everyone universally loves next week.
I like it. But on the bright side, loves the show, watching from Minnesota. So appreciate you. Probably the most active commenter on any video that we do on either channel. So, giving us a thumbs up and making a comment. So we appreciate that.
Is that a
All of it
challenge, or
helps.
are you telling other viewers that they
No,
need to
I'm just
step up their
saying they do it
commentation
without us
game?
asking, and that's awesome. So I appreciate it. Jorge says devastating Los Angeles fires are going to displace hundreds or thousands of families that will need to temporarily live in other places. Will that drive up house prices in Los Angeles? To some degree, yes. Especially in those markets surrounding the Palisades, Santa Monica, some of these markets where homes are of similar value. You're essentially in the same area, but not really. So you're still close to all of the other things that you were. Those people that have the ability to buy, because a lot of people don't understand that even though your house burns down, if you have a mortgage, you're still responsible for paying that mortgage. Now, there might be some forbearance options. There might be some different things happening that delays people having to do this. But the reality is you're still responsible for that. So if you're going out to buy a new house or to rent, you still have to be able to pay your rent and pay the mortgage in theory, because of everything going on. Now, there's rent loss insurance. There's a couple of other things that can help you out, but you got to think of it from that perspective. So anybody going out and buying another home in this situation is pretty well off financially, or you know, at least by the looks of it, they would be. So
What you just said, Jeb, I think is the most important part about it. This would, if those fires had ripped through entry level areas, homes of $500,000, $600,000, $700,000, it would be really problematic. Just it's not that it's 20,000 homes, but it's thousands of homes. So it's not good for anyone. But those were high end luxury homes. So I would say it would absolutely impact, because some of these people are literally rich enough to just go buy another one instead
Sure.
of rebuilding. And even those that aren't, what I really would not want to need right now is a luxury rental in LA County. And I'm not saying like a $2 million house. You know, $3, $4, $5 million rental in Los Angeles County over the next year or two is going to be really expensive.
Yeah, and with that said, I think it would be crazy for us not to realize, or be naive to think that everybody there had money, right? Some of these people own their houses for 50 years and were probably living on Social Security and had nothing else other than that house. So there are people there, even though these were multi-million-dollar houses, that aren't in a position to just go out and rent something at the prices that are needed in order to compete in this market. So there's a lot going on here. There's a lot to still unpack. This is going to be something that continues to affect that area for months, possibly even years in some cases. So, but getting back to the question, yes, I do believe it will drive up home prices in some markets of LA. All of LA, no, right? It's not going to be, East LA is probably not going to be impacted by what happened in that area. And if a fire broke out there, yes, that would be impacted. So LA is a very big area.
And think about that, Jeb. For those of you who've never been to LA, East LA, there are a lot of hills through East LA, and those are entry level homes. If that fire had hit that area, I would be far more concerned about our audience here. I'm very concerned about everyone. I don't care if you're a bajillionaire, having your house burned down, and some of these people dying was horrific. But in terms of just talking about the numbers of the housing market, we have hilly areas that have the potential to burn that would have been, when we had the Northridge earthquake. That would probably be the most interesting thing, Jeb, to go back and look. You didn't live here then. I was in college, but I came home spring break. I went to see my buddy at Cal State Northridge. I'm like, what are we talking about? You drive through neighborhoods, every other house is off its foundation, getting dozed. And I'm sure that had an impact, a different economy, a different time, but I'm sure that had an impact for people wanting to buy in those areas that were heavily impacted by the earthquake.
Yeah, I mean, what happened here, again, last thing I'll say, will have long-lasting implications between insurance, between housing displacement, affordability, a lot of different things for not only that market, but it's going to push, those problems that they're into other markets and create additional problems. And supply is one of those, right? When you lose a couple thousand homes, that presents huge problems for the housing market when you've already got issues. Moving along. So Chris, probably my biggest fan when it comes to beard, mustache, comments every week. Actually had another comment in here from Alex talking about the beard, but wants me to grow the mustache longer. I can't. No, we're not doing the mustache of the lip. No wax. I'm not a hippie. I live in Southern California, not
The wax
Portland.
isn't hippie, it's hipster.
No,
Two different
hipster.
things.
Well, hipster. That's what I meant. Hipster. Yeah, we're not curling the mustache here. That would, yeah, I'd be wearing a beanie next. It would get really weird here on the show. Anyway, M. Sandoval, been waiting to locked in
Brother,
on Monday.
we already answered this one.
Oh, we did. Yes, we did.
Well,
Why didn't we?
let's
why
stick
is it
with,
still in there, bro?
let's stick with rates and some interesting questions here. So Nova Cloud Skills, I got a 7.34 rate, and I'm trying to refi to 5.4. However, I'm paying $25,000 for closing and $9,000 to buy points in Georgia. That's insanity. Unless you think that rates are never going back down, you would have to be in like
Hold
your
on.
loan officer. Just give me 1 second, and then I absolutely want to hear what you have to say. But your loan officer should pencil out for you how long rates would have to remain elevated for you to come out ahead by paying that much money to buy your rate down to that level.
Yeah, I'm asking, like, what are you saving per month by doing this? I mean, if you saved $1,000 per month, it's still going to take you 3 years to recoup your cost. Like, that's crazy. No, like, that's not. I don't think that's a good idea. Personally,
I would bet, Jeb, that they're talking to a call center loan officer, the biggest retail lender in the country. They love this. They have their little spreadsheets, and they're going to show you, we're going to save you this much. That rate sounds fantastic. But then you look at the fees and you're like, why did I just trade $25,000 of my home equity for a $295
But they're also
lower
paying
monthly
$9,000 in points. It's 34 grand, dude.
Yeah.
No chance. That's not something I would remotely consider.
No.
But talk to somebody
so
else.
he follows up. Balance on the mortgage is $476,000. So we have a team member licensed in Georgia. If you want us to just review the numbers at 7.34, if you're on an FHA loan and you can get it to 6.375 with 0 points, we can consider it. But if it's a conventional loan, you're going to be paying a ton of points to get it significantly lower. So reach out. We would love to just look at it for you. I don't think there's anything that makes sense to do right now, but I would absolutely not pay that amount at any time for a refinance. And Ali is coming at it from a different angle. Ali says, bought a home in Temecula with an ARM in July of 2023 at a 7.625. At July of 2023, I mean, yeah, we haven't even hit 2 years, so it must have been a 1 year ARM. Next Bank offers a 1 year ARM. Next Bank offers a 1 month adjustable, Jeb. So the crazy thing is, it shouldn't have adjusted like that. I would love to know what's going on there. That's not a standard ARM, but let's say if rates, we just looked at the top of the show, Mortgage News Daily reporting 7.125. If you're at 9.625 and you could get down to 7.625 on a no cost loan, what are we waiting for? Why are we waiting for rates? Rates are 2.5% below where you're at. If you're in Temecula and it's a house, not an entry level condo, it's a $500,000, $600,000, $700,000, $800,000 loan. You can absolutely justify doing a no cost now to lock into a fixed rate. And then obviously we hope that rates will move lower and you'll get the opportunity to do it again, hopefully later this year or the next couple of years.
All right, and we're going to follow that up with another rate question here. Do you think rates will see 6% by the end of the year? So if we took, I think it's the average of like 14, I believe it was 14 different entities, is where I guess we're going to call them. The average was where they see rates by the end of the year was 6.3%. So typically when you see the rate that is being quoted out there, especially in an average type situation, usually the market offers better interest rates than that as a whole, especially for well-qualified borrowers. So I think if the consensus is right and we're seeing 6.3% as an average rate by the end of 2024, which is essentially the prediction, could you see a 6%? I think you could. I think there will be 6% interest rates out there at that time, assuming you're well-qualified, you have the down payment, you got, good credit scores, that sort of thing.
Jeb, we talked at the top of the show, the context of, hey, everyone's excited because rates are better today, but they're really no better in the last week. That's about as long of a time frame as anyone has. We had a comment in this week's episode of the podcast on YouTube. Someone wanted to bet us that rates wouldn't be below 6.5 this year. And I'm like, okay, well, let's just look. The last 2 years are the two highest interest rate years we've had on record in the last, I don't know, 13, 15 years, somewhere along that line. And for 60 days of last year, we were under 6.5%. And people don't remember this 2023, 90 days of 2023, 25% of the year, we were under 6.5%. And both of those years, I closed conventional 30-year fixed loans without paying a ton of points under 6%. They weren't much under 6%, 5.875, 5.99. But this isn't some crazy ask like, oh my God, would that be just nirvana if we got under 6%? Am I going to call for it? Do I think it's going to happen? I think we're going to know in the next 90 days. So we come back and ask us in 90 days, and I'll tell you if that data works out the way we think it is, and core PCE is at or below 2% by the time we see the March reading, February reading released in March reading released in April, then there's a very, very good chance that we will get there. A million variables, a million things, and I hate to say data dependent, but the data needs to play out the way we think that it could, not that it will, but the way we think that it could. If that doesn't happen here over the next 90 days and you're pushed out further, probably looking at something in the low sixes being your best case for the year.
All right, good stuff. If you're finding any value at all, do us a favor, hit the thumbs up. If you're not subscribed, consider subscribing. It helps us continue to grow the channel, accomplish our goals, and that is part of the reason that we're here. Mina, one of our regular viewers here, came on and said $5 super chat. So thank you, Mina, for that. Much appreciated. As always, every week, for those of you not paying attention. But
she has two questions. She has two questions. And two important questions.
The first one is, should add-ons like decks and pavers be cheaper after purchase, or is it better to go through the builder? Want to know which one of you. Okay, so the first question about pavers and just add-ons in general. Typically speaking, the builder is going to charge a higher amount for those things. So they're typically not cheaper through the builder. But one nice thing about the builder, if you're going to do them, is that you can finance the purchase of them into your loan, right? So it's paying $20,000 for pavers into your loan is, 100 or $50 a month, right? More on the mortgage payment. I'm just throwing a number out there that's not accurate, versus $20,000 out of pocket after closing. So you kind of have to weigh what you want to do. If you have the money, I would say, just do it outside of closing. Might pay a little bit more, but you're not financing it over an extended period of time, which is essentially what you're doing with rolling it in there. But there are some times when it does make sense to do it. And builders might be incentivizing, in some cases, you might have a little bit extra money that they're using to help you, whether it's buy down the rate, use towards upgrades, that sort of thing. So I think it's kind of weighing both sides. And then lastly, the better question, which one of you grows a beard faster? Josh probably does, but Josh is too big of a. He's weak.
Here's the breakdown. I would say mine actually does grow faster. Jeb has the wiry, like lumberjack mountain man beard, and mine is a little. Jeb has a whole different thing going on over there.
There you go. I don't know which one's freezing. Typically, when I say you're freezing, they say I'm freezing. So one of us is freezing.
Someone's freezing.
Yes. How does refinancing rentals differ from refinancing a primary residence, Josh?
Really no difference other than your income calculation is going to be more difficult because we're going to need to get the tax returns and see what the rental history was, income, expenses, all that stuff. But the only real difference is you're going to have additional loan level price adjustments, meaning higher interest rate for a rental than a primary residence. And we used to say than a primary residence or second home, but now second homes per Fannie and Freddie are priced the same as a rental property. So a little more work for us, a little more documentation for you. So I guess a little more work for you as well, but the loan's going to be identical in most situations.
All right. Buying points, Josh, is it cheaper on a 15-year fixed or 30-year fixed, or is it essentially the same?
Interesting question. And I would want to actually research it, because just like a 15-year loan is cheaper, the reason being is you're going to have use of their money for a shorter period of time. I'm just trying to think my way through it. If the lender thinks a 15-year loan is going to pay out to maturity, then it should be easier to buy the interest rate down because there's less money lost to them. So they have a little bit more certainty, but I've never really looked at it. It's nothing that's ever stood out to me when pricing a loan, where we would get away from that general rule of thumb that paying a point will get you down 0.25%. So maybe I'll do a little research this week and answer you next week if you're back here.
All right. Kevin's asking, anyone know why new construction are mainly townhomes? Having an HOA is a turn off. So I wouldn't say most, maybe in the area that you're in, there's a lot of townhomes, but understand, what happens is a lot of developments, depending on where you're buying, are infill developments. There's not a lot of available land, like especially when you look at Southern California, right? So they have to go in and build in small areas. And what's the best way to build in small areas? To build up, to build, smaller lot size with properties that go higher. Townhomes are kind of what you're thinking of here. So that's why, to maximize profit. That's why they do it. Especially when they have these smaller lots, they can build more homes in those areas. HOAs, when you do townhomes, they're connected, that sort of thing. You have to have an HOA because you're connected to someone else, and you need something for maintenance, for roofs, for to take care of these communities. Because it's not just your responsibility at that point, because you're not a single family home. So some say they're a turnoff. I don't mind HOAs. I'm pro HOA in many ways, just because of what it keeps out and what it keeps people from doing. But that's just me.
Jeb, I have a story. I have an HOA story. You'll
right.
like this. Hopefully this person's not watching. I doubt they are. Our place out in the desert, 850 units. So there's multiple committees. So one of them is the pool committee, and we own it with my in-laws, and my in-laws were out there. My father-in-law is at the pool, and he meets a guy, or actually he was out walking around the golf course, and he meets a guy, and he goes, "Oh yeah, that guy down the way, he's actually on the pool committee." I go, "Well, you realize the pool by our house, the landscapers have not been coming inside and actually cleaning it up. So it looks pretty janky." And he pointed it out to his buddy that the pool that was literally like 12 units away from him had not been being maintained at all. And he goes, "Really? I'll have to go check it out." So a lot of times you do get situations, especially where we are, it's an older community. So you get retired people and they think it's a fun thing to do to volunteer for these committees. They don't actually realize that there's work and effort and energy required.
What? Get out of here.
Yeah.
That's
why you quit. That's why you quit your board, Jeb. Too much work.
Well, there was that. But I'm considering going back on, Josh. Considering
in all your spare time.
I'll make time. I make time to make change, Josh. That's what I'm looking for. So I don't know. I haven't committed yet. Hopefully none of them are watching and swindle me in, but I'm considering.
They might run a campaign against you, a smear campaign to keep you off, to not get you elected.
My wife wants to keep me off of it, and that's basically what Dixie's saying here. That he's asking me, isn't it about time for Mama to have me shave the beard? No, it's coming. She's I think she's close. I think she's close to that level, but my kids want it, so it's kind of 3 kids, 1 wife. The wife clearly overrules, but she's kind of letting the kids be the deciding factor here. So we might look like ZZ Top by this time next year. We don't know.
Going back, this question and Mina's question, what I want to go back to is, will the Wolverine stack increase the pace of grow in? Can we grow them in like a week?
We're going to find out. We're going to find out. And if you guys know what I'm talking about, if you guys know what Josh is talking about, then you can comment in the
if anyone is on the Wolverine stack, we want to hear feedback before Jeb does the test for the 2 of us.
Well, it's already ordered, so it's happening.
It's coming.
It's happening. It's just a matter of when it comes. So anyway, that's where we're at. Do we have any more questions here, Josh? Just you.
There is one here. Well, first, let's go back to Ali. Excellent clarification. He says it's a no-doc loan. That's why the interest rate is higher, and that's why he had that shorter term fixed period. And then also $190,000 loan. The house is worth $800,000. So we're right on the value, but he put a big down payment, has a much smaller loan. So 100% correct. On a smaller loan like that, you can absolutely justify holding off and waiting it out. It's not nearly as painful as if you had a $600,000 loan on that. So just wanted to throw that context in there for those of you who were wondering. DCF says, I may have asked this before, but I have an adjustable rate in the upper fives from 2018 up for adjustment in 2018. Should I lock in a rate between now and 28 if rates ever go down to those levels? You put your 2 cents in on this, Jeb, but we literally, depending on credit score, loan to value, and property type, we hit that in September or so. And I would say absolutely. If you're able to do a low or no cost refinance, get that thing onto a 30-year fixed, or you said it's from 2018. So what, you're 7 years into that, a 23-year term, a 20-year term, that would be sort of the ideal. But you have any thoughts on that, Jeb?
I wasn't paying attention, Josh. Let me read the question.
This guy's not paying attention. He hears the music from the intro. He's dancing in his
it's
head.
still ringing in my ears. Should you lock where, I mean, so you have an adjustable rate now in the fives and you're asking if you should lock it. What's it going to adjust to? I think is a good question here.
Well, generally those were all LIBORs, and they're now switched over to SOFR because LIBOR doesn't exist.
Yep.
SOFR follows the Fed funds rate very, very closely. So figure out what your margin is, see where SOFR is right now, and actually you can follow the Fed on this and kind of see what you think is going to happen next.
Yeah, I mean, if your rate is somewhere in the low sevens on this thing, when it's all said and done with the adjustment, I don't know. I don't know. I think I would be more prone to, depending on the cost, Josh, if I could get a no cost refinance, then I might consider it. I don't know. I don't have an answer for it yet.
Let's turn it around. Why would you not do it if you could do a lower or no cost refinance and convert that to a 30-year fixed?
Well, because your rate's going from 5 now to 7 something.
Well, he's not saying do it now. He says, should I lock in a rate between now and 28 if rates ever go down to those levels?
Oh, yes. Between now and 28, yes, absolutely. I thought we were getting ready to adjust. Sorry.
No, he's not adjusting for 3 years. And kind of going back to that question we had a few minutes ago about adjustable rates, this is a really good example. So let's say he does nothing. So if it goes up in 28, he bought in 2018, he got a 10-year adjustable. So with that, now mind you, we had 2% and 3% interest rates in between there. It should have been refinanced a long time ago. But in this situation, at the end of 10 years, he's going to have a 20% lower interest rate, 20% lower loan balance. If we say over that 10 years with 3% wage increases, he's making 35, 40% more than he was in 2018. It's not really a concern. So that long time frame gives you a lot of optionality, time to consider things like this, but you want to make sure you're getting a nice discount to market to make it worth dealing with all of it.
I got confused. You said something about a 7-year, so I thought 2018, that means it's adjusting in 2025, blah, blah, blah. Anyhow, 2028, I think you got some time for rates to trend down a little bit and take advantage of something. So, What says, well, currently they're renting in Irvine, by the way. Said they haven't bought because it's expensive, but asking thoughts on new builds at the Great Park in Irvine. So, this is one of those areas that has a lot of development. Irvine's one of the, is a master plan community, very well planned out, and towards the end of that, build out, but the Great Park, my thoughts on those, I think floor plans can be nice in those properties. I'm not a big fan of the super small lots that they're doing in Irvine now with a lot of these new builds. So depending on where you're talking about and which community you're talking about in the Great Park, a lot of the builders are good builders. They're, nice communities. But you have to understand what you're buying, right? It's more of a townhome style property, and you have to be okay with that. And you have to probably be okay with Mello-Roos as well in a lot of these, which means property taxes in the, high 1% to almost 2% range.
Shit, Jeb. We just got a news flash and we got corrected. The limo driver is telling us all rates are going higher, much higher. I think he listens to the Fox News while he's driving the limo around, so he's got it figured out.
Well, that sucks, man.
Let's go home. Now we know what the future looks like.
Oh, Josh, what are we gonna do?
Find new jobs.
Well, I guess so. I mean, that sucks. Well, while we're here, we'll keep going. We'll just keep lying to you guys and tell you they're going lower.
Keep making up news and data.
Yeah, it's great. But yeah, that's what we'll do. So that's fantastic. Must be slow times in the limo days these days if you get time to just comment while you're driving around.
Well, hopefully he's just listening and not watching these two ugly guys while he's driving around.
Maybe his limo has a self-driving and he's just driving and doing it. You never know.
Has anyone that's what I want to know. Comment over here. Has anyone been in one of these Waymo taxis that doesn't have a driver? That's just
I would definitely take one of those.
I would do it, but I did see a news story. A guy was traveling, and I think he was in Scottsdale or Austin.
It
went in circles. It just went in circles.
It was fantastic.
It was making him dizzy.
And if you haven't seen that video, it's fantastic. He calls the lady and he's like, basically telling her to take over. He can't get out because the doors locked him in. It was hilarious.
It sounds.
And then
like
he was late for his flight.
What was it with Carrie, Christine? What was the haunted Cadillac that was killing people? It was Christine, I think. That's what it sounds like to me. I don't like that.
It's wow. I was gonna say that's good stuff, but it's not really good stuff. All right, guys, it's 55 minutes on. We are still looking for some questions. If you guys have questions, let us know.
I guarantee you, Jeb, when we hit minute 58, there will be 5 questions popping.
Well, the good news is we're 3 minutes ahead on this chart because we started the clock to let the music run. So we're actually have a little bit longer than we would normally have. So if you have questions, start putting them in the chat. I'm going to mention the webinar once again. So January 28th. We have a webinar coming up. It is not on YouTube, guys. So if you're thinking you're just going to come here to YouTube and watch it, you will be wrong. Throw it up there, Josh.
Where did it
go?
What are you doing? There it went. I was trying to get the right one.
This is at 5 p.m. Pacific Standard Time. It will be done via a link, kind of like Zoom, where you're basically going to get the link and we're going to be on there and you're going to be able to ask questions. But primarily, it's going to be Josh and I teaching you the home buying process from A to Z, walking you through, our 3 steps, if you will, in this process. So I think there's like 150 people registered the last time I checked before we came on. If you want to be part of this, register. We will cap this. I don't know what our number, Josh, is, but it will get capped in. We still got about 2 weeks before it comes on. So if you're interested, sign up. You'll have the link and we'll go from there. But anyway, I just want to mention that the numbers dropped off as I started talking about that, and we still have time here. So you people who left, you lost out. That's all I want to say. Anyway, Josh, what do you want to talk about?
We talked about the self-driving taxi. It's been a slow day. I have my head down running numbers, so I don't have a whole lot of interest.
You don't have a lot of interest. Is there a cost? There is no cost. There is no cost for the webinar. It is free. It is there to educate and guide you, to help you buy right, borrow smart, and ultimately build wealth. And it doesn't matter if you're buying a house in a month or 8 months or even a year from now. The information is going to be it's going to be pertinent regardless. So I think it's definitely worth considering. And if you're not interested, for somebody who is. How's that? What do you think about ADUs, Josh? Is it worth building them?
Building costs are high. It really just depends on what you're thinking. I think in the short run, they're about break even. Strange how markets are efficient in that way. Over the long haul, should lead to greater appreciation. As rents go up, I mean, you're going to have a fixed cost to build it, a fixed cost to finance it, and then rents will go up over time. So it's like any other real estate. I think it's a good investment if you have the right property and it's done right for the area and you do something that is desirable. Or let's look at the flip side. Maybe you have your mother-in-law living with you and she sits in your easy chair all night and yells at you and tells you what you're doing wrong, in which that case, it would be the greatest investment you've ever made.
Oh, that's great. I showed property yesterday in South LA, actually, from a viewer of the channel. You guys have maybe heard me talk about, if you haven't watched the video, there's a grant out there. If you're in Southern California, pay attention to this. It's, Ventura down to San Diego. And it's a grant, depending on where you're buying, mostly LA, $50,000. Free money, guys. Free money.
Which we always tell you there's no free money. This is
free money. No mortgage insurance on this loan. Interest rates are actually better than conventional financing, and it's free money. But there's also San Diego, Orange County, up to $20,000 in grants. Anyway, have somebody that qualified for the grant. We were looking at some properties in South LA, And we were talking to one of the agents who has a property where they have plans for an ADU. And so I asked him, I said, what are you guys spending to build ADUs? Because on this one, they're not going to build it. They're just going to give the plans over that have already been approved. And he said it was on top of a garage. So it was a 2-story garage with about a 1,200 square foot unit on top of it. And he said they're spending about $175,000 to build those. So, take that into consideration if you're thinking about doing any sort of.
Did they give you any indication of what market rents are for it once it's done?
He didn't, and I didn't. I mean, my clients weren't really interested in it, and we were kind of moving along, so I didn't really ask a lot of questions. But 175 to build it, give or take, I would probably say it's probably closer to 200,000 if I had to guess, between planning, permitting, everything else, and I would think in that market, it's probably rents would probably be somewhere in the 2,000s.
And in a perfect world, if you were able to finance the whole thing, it's going to add $1,200 to $1,500 to your payment. So not a ton of additional revenue there. But again, if it gets your mother-in-law out of the house.
You would think that you didn't like your mother-in-law, Josh.
My mother-in-law is fantastic. I get to spend the weekend with her this weekend.
There you go. Let's see. What do we got here? Thoughts on Tesla Powerwall 3. Would you consider it a good investment for the house? I don't know what the Powerwall 3 is. Is that some sort of, is that the one that goes in the storage, Josh, that your solar panels feed into that Powerwall?
I'm Tesla ignorant. Maybe he just means he's going to get 3 Tesla Powerwalls, light up the whole neighborhood.
I think it's basically a big battery that goes on the wall in the garage that stores power. I don't know enough about that to be able to tell you whether it's a good investment or not. What I will tell you about solar and that sort of thing is that to each his own, right? Some people think it's the greatest thing in the world. Other people are like, why do I need that? I'm kind of one of those people, kind of in the middle. For a long time, I was really against solar. Now I see the benefits in some ways, but I would never lease it. I would only buy it outright. And for me, it would have to pay for itself in a short period of time to make sense. Just because over time it's going to need maintenance. You're going to have to take it off to replace roofs and all of these different things. And while these companies say, hey, we'll do all of this stuff, the reality is a lot of these companies will be out of business by then, and they'll pop up as a new company so that they don't have to do these warranties. And call me conspiracy theorist, but I'm telling you that's what's going to happen because there's going to be more and more issues, and the technology is getting better and better. So the longer you can wait on this thing, I think the better off you're going to be long term. But at the same time, the power companies now know, and they're jacking. It's like it's not as great as it once was, but it's better than it was. I don't know. Anyhow, does that make any sense?
Those of you who think Jeb's kidding about these companies going out of business, I would say 90% of the properties that we finance that have a solar lease on them, the company we're dealing with on getting the lease assigned to the new buyer or getting the subordination for that buyer is not the company that they did the original lease with.
No, it's not, because these people don't want to live up to all that, take them off for free. We're going to take your solar panels off for free and let you put a new roof on, and then we'll just come back and do it for free. No, you don't make money doing that. It's a good sales tactic, but in reality, it doesn't really work very well. Okay, Josh, it has been an hour and 2 minutes. We're losing people by the second here. They don't care anymore. They want to move on with their night.
They don't want solar. They're out.
They don't want solar, and I understand that. But if you're interested in speaking to Josh or myself, you need help with a loan, you need help with real estate, you can reach us using that referral link that's scrolling the bottom, jebsmith.net/referral. If you want to get in touch and watch the seminar, jebsmith.net/seminar. If you want us to watch your rate, jebsmith.net/rate watch. We got a lot going on here. We offer a lot because we like you, but we'll be back next Wednesday, guys. Until then, adios.
Amigos.
You owe me an apology.
Don't step on me again.
You owe me an